Armanino's webinar on SEC, a look at trends in comment letters. My name is Lori Colvin, and I will be your moderator for the afternoon. And first, a few housekeeping items. If you notice on your webinar pane, you have the ability with the arrow to decrease or increase your window. And your window is the spot where you can type in questions throughout the webinar. And we will then hold questions for the end of the webinar, but be sure to type them in so that we have those queued up. Also, when you are on your webinar, you'll want to click either the telephone if you're listening through the phone or your mic and speakers so that you get really good, clear sound. So today's webinar is worth CE credit, and so for those of you that will be taking CE, there are 4 things you got to make sure that you're doing to qualify. You need to be on a personal computer. You need to be on for at least 50 consecutive minutes. You need to answer 75% of our polling questions, and you need to complete the survey at the end of the webinar. And I have the pleasure of introducing both of our presenters today. First, I'll tell you about Matt Peralt. He is a partner here at Armanino that leads the public company audit practice. He's actually comes from private industry as well as public accounting, works heavily in the tech space, and has worked on tech sector transactions, S1 filings, IPOs, and M&As, so has a lot of experience in this area. Our second presenter is Dave Davis, who is also a partner here at Armanino in the consulting practice and leads the financial management with a lot of technical accounting area that he covers. He also, like Matt, spent time in private industry as a CFO and a COO at public companies, has a lot of hands-on experience there. And this last part of his career, he has been consulting and works on preparing S1s, investor reporting, M&As, and a lot of public company experience. So today we're going to go over a few learning objectives, and then I'm going to turn it over to Matt. Our learning objectives for today is to really review the organizational structure of the SEC and really discover how the SEC comment process works. We're going to review some of the top SEC comment areas and then analyze those comments. Really, we want you walking away understanding some trends and what to look for so you can be better prepared in your own practice area. So I'd like to turn it over to Matt. Thank you.
Thanks, Lori. So as Lori said, we'll touch on the organization structure and how that comment process works. And the way we're going to do that today is we've got 6 specific comment areas. We took a look at the top 10 comment areas for companies. We did a sort by Northern California region and then did a deep dive into the financial statement issues associated with those or the gap issues associated with each of those comments, and we're going to dive into those. And then we'll also take a look at SEC comments outside of the F pages and focus on non-GAAP financial measures, risk factors. We'll take a look at a recent S1 that was Solar City and just sort of overview of their comments and responses, and then we'll talk about best practices.
So one of the first things we want to discuss and present is just what's the mission statement of the SEC? It's to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. And they do that through a series of divisions of corporate finance, enforcement, risk, strategy, financial innovation, investment management, trading, and markets. And under corporate finance, what they try to do there is they seek to look at things from the investor standpoint, make sure that the investors are getting the information they need to make informed investment decisions. They also provide interpretive assistance to companies with respect to SEC rules. So if you have a question, you can solicit a input on that. They have an enforcement division that investigates possible violations of securities laws. The Risk Strategy and Financial Innovation Group is the Commission's effort to identify, analyze, and respond to risks and trends in the markets, especially related to things like new financial products and strategies that continually seem to come out of Wall Street. Next one, investment management, is the regulator for investment companies such as mutual funds, closed-end funds, interval funds, etc. Trading in markets, the last one up here, is establishes and maintains standards for fair, orderly, and efficient markets. So they're the regulator of the major securities participants, including brokers, broker-dealers, self-regulatory organizations, and transfer agents.
Okay, so we're going to have a first polling question. Speaking of the SEC, we want to ask you, and remember you need to answer 75% of these to qualify for CE. The first polling question is, who is the current SEC Commission Chairman? Okay, and you'll want to hop on and answer that question. Okay, and we'll close the poll in about 3 seconds. We've got 3, 2, and 1.
Thank you, Lori. It looks like everybody thinks Mary Shapiro is still the chairperson, and she is not. Mary Jo White is the correct answer. And that is a rather recent development. I forget the exact date, but rather recent. And here is a group, the list of commissioners with Mary Jo White at the top as chairperson and the other 4 commissioners. Okay, so let's talk a second about the SEC review process. The goals for the SEC are to increase transparency in the marketplace and express staff willingness to discuss issues with registrants. Those are goals that the SEC has in their review process. There are two main sections, and this is just a bit of an overview. There's a filing, a review process, and a reconsideration process. The filing review process are the experts in various specialized industries review filings from an investor's perspective and technical perspective, and then provide feedback to close those and to respond to reviews and close those reviews. The reconsideration process are the steps that are guided through for reconsidering comments that are issued by the SEC to you. So I think next we have Matt's going to give you an overview of the top 10 comments.
So yeah, we just took a look at the SEC's Edgar database and ran this and then sorted it by accounting issue. And so as you look through, these are the top 10 accounting issues, and we did isolate technology companies that had a Northern California zip code. What's interesting about this is the top 4 areas of comment are all the same as they were last year, with the exception of 3 and 4 that flip-flopped. So you're seeing pretty consistent comment on the more important areas that you would expect, and that being revenue recognition, income taxes, and certainly fair value measurement, just because of the significant degree of judgment surrounding anytime you have a fair value measurement and just the ability to manipulate or influence earnings or revenues every time you have to develop those assumptions. So now we'll dive into 6 specific areas of comment. The ones we're going to take a look at are business combinations, capitalization of costs, VIEs, debt, fair value measurements, again, just because that was number 1 on the hit list for the SEC. And then finally, revenue recognition, and with a focus on revenue arrangements that have multiple elements.
And before we jump into that, we're going to have polling question number 2. Lori?
So our second polling question is this. We're kind of curious about your own personal experience. Have you been required to amend a filing as a result of an SEC comment? We want you to answer yes or no, or if you're not sure. We're going to leave the poll open a little bit more so you can cast your vote. Okay, and we'll close it in 3 seconds. And 3, 2, and 1. We're going to close the poll.
And we have some results. It looks like the majority of the listeners to today's webinar have not had to amend a filing. I wish I had been in that bucket when I was in the corporate world. I was in A. Matt, how about you?
No, I was always an A. No, I think it's pretty consistent. Our observation has been that the majority of comments the SEC provides are typically forward-looking comments, and usually they introduce every single comment by saying, in future filings, please revise to accommodate, and then it'll go into their actual observation of their comments. So I think, you know, those percentages make sense with what I've seen in the industry.
Okay, thank you, Matt. So let's jump into some specific SEC comments. This particular comment, and no, I'm not going to read the entire comment to you. Basically, this is related to a business combination and purchase price allocations. The issue that is up that they're bringing up here is purchase price allocation assumptions and estimates. So what do we have here? The bottom line is that at the end of the day, the SEC is very concerned about defining all the intangible assets acquired, which is the first step in the allocation process. They're concerned about having complete and thorough descriptions of the methods and assumptions used to determine the values assigned to the intangible assets. Reason being that most of the time you're developing these assumptions as management assumptions. You may be having third parties assist you in valuation of various intangible assets, and this is a very murky area and can be challenged quite easily as to how you came up with those assumptions and why you made those assumptions. And so at the end of the day, you've got to really look at the guidance that's in ASC 805. Specifically, I would recommend looking at 805-10-55, which provides implementation guidance, so it gets away from the strict rules and gives you some real clear understanding of what the implementation guidance is actually intending. And then there's a couple other sections, 805-10-55S and S99, which relate to SEC materials related to this. And the last point I want to make is that in your disclosures, you also need to deal with something called assumption uncertainty. And you need to discuss it. And what you're really trying to do there is give information related to the events or that could impact the assumptions you have used to make your calculations of your intangibles. So those are the things you need to think about and focus on.
And I'd imagine the SEC's focus here on doing the purchase price accounting is to make sure that the registrants are not pushing too much of the purchase price into goodwill, which is a non-amortizable asset. Certainly, I think that would be the natural orientation, is to not put dollars into intangible assets that you would have to value and then amortize, because that's going to have a continuing drag on the P&L.
Excellent point, Matt. Thank you.
All right, so the next comment we're going to take a look at here is capitalization of costs. You'll notice that this particular comment focuses on a company that is capital equipment intensive, but the comment could just as easily apply to capitalization of software costs. And the real focus here is on any areas that are judgmental and that assumptions could be changing over time. And so what the SEC is asking is that you put in place an objective framework, that you describe that framework that you use to capitalize costs. And certainly with respect to internal costs like payroll, interest, and anything G&A, they're going to take a particular focus on those type of costs and make sure that you're capitalizing those consistently. And then certainly whenever there's capitalization surrounding a project, whether it be a physical project or a software development project, you want to take a look at how robust is your documentation and your policy around when that capitalization begins and ends. And I think with any disclosure the SEC is looking at, they want to be sure that there is consistency in the application of your policy year on year. So to the extent you can develop tables that show dollar amounts capitalized year on year and dollar amounts expensed year on year, I think that will eliminate or certainly reduce the likelihood of an SEC comment in this area.
Okay, and we're going to go on to our third polling question. And again, I want to encourage you, you can type questions in throughout the webinar. In fact, we had one which is always a popular question is, can you get a copy of the slides? And yes, the slides and the recording will be available on our website, amllp.com, within 3 days. So our third polling question is a true and false one. The SEC will often ask for supplemental information not provided in a filing. Is that true or false? This will give an indication of your experience with the SEC as well. We'll keep the polling open for another few seconds here. Okay, we're going to close it in 3 seconds. We're at 3 and 2 and 1. Thank you.
All right, let's see what we have in response. Majority went with true, which is the correct answer. As Matt stated earlier, the SEC often asks for information to be added in future filings. Well, one of their other favorite lines is, please provide supplemental information to them and then amend future filings with that information. So they may not ask you to go back and amend your current filing, but they'll ask for supplemental information to get a better understanding, and then they'll ask for that to be incorporated into the future filings. Right, let's go back to our top 6. Next one's consolidations and VIEs. This comment is related to whether or not the company has done the analysis required under FASB Topic 810-10 and related to variable interest entity analysis. And the real issue from the SEC is the quality of that VIE analysis. So let's move on to the next point. So basically what we have here is that 810 requires that a VIE analysis be conducted as a first step in the consolidation determination. A little different than some in the past. It's now a required item, and it's a qualitative analysis that's required nowadays. You may own more than 50% of something, but you may not consolidate it because on a qualitative basis, you may not have the power to direct the activities. It's not a bright line anymore. It's what are the things that you have to consider? You have to consider whether you have the obligation to absorb losses. You have the right to receive benefits that could be significant to the VIE. You have to consider various things like management activities you may be part of, servicing activities you may be providing to the VIE. What are the financing arrangements? Are you providing a guarantee, for instance? So we're not just looking at board level activities anymore of who makes a final decision. We're looking at all of the different facts and circumstances of that particular situation and arrangement with that variable interest entity before you can conclude that you should consolidate it because you have you're the beneficial controlling interest. So that's basically where they're going. They want to see a lot of disclosure about how you as management concluded that you should consolidate it and what that conclusion was based on.
And I'd imagine you can expect this is an area where the SEC is probably, again, likely to ask, maybe in their first comment, they wouldn't necessarily ask for supplemental information. Maybe it's just respond to us in terms of replying to the question. But then once you've provided them that management memo, there's probably a likelihood that they would then turn around and say, okay, now give us a copy of that agreement so that we can verify you've properly interpreted the conditions of that agreement.
Okay, thank you.
All right, so here was the number one area of comment, which was fair value. And I've actually sort of distilled this into two comments. The first part of this is really speaking to a investment that the company holds in both, or investment in the company that's held both in the equity and mezzanine portions of the balance sheet. And the company in this case is elected to carry those instruments at fair value. And so the SEC is asking here to disclose any inputs that they used in terms of determining a pricing and valuation model and assumptions. And then also they're asking for significant unobservable inputs and assumptions, which again in the fair value hierarchy are level 3 observations. What's interesting is that the majority of this, and we'll flip on to the next comment here. I'm sorry, did you go back one, Michelle? Oh, I guess we cut the next slide. It's only in my hard copy. Okay. Let's go ahead then to the next slide. So the real key consideration here is the FASB issued back in 2011 an accounting standards update 2011-4, and that was 398 pages of changes and modifications to the existing fair value disclosure and calculation measurement rules. And really it had a laser focus on anything that was judgmental. It clarified the FASB's intent regarding the fair value measurement principles and went into more detail on what is the definition of a principal market, the fact that you're supposed to be calculating fair value as the exit price for the person holding that instrument. It also talked about the use of premiums, discounts, making sure that the asset or the liability is evaluated at its highest and best use. And so an example there may be a technology company that goes and buys a competing technology in order to retire it. Well, you wouldn't necessarily value that asset at the retirement value, but again at what the average market participant would be using that. And then certainly anything that is a level 3 fair value measurement, because those are both not observable and there's not an active market for those. And so you would have to imagine that anytime you're going with a level 3 method to value your assets, there is a significant amount of judgment, and the SEC wants expanded disclosure around the judgment that you used. So what is it specifically that they're looking for? A narrative description of the sensitivity to the changes. And so a simple example there would be if interest rates go up and you hold mortgage-backed securities that have fixed interest rates, well then it's likely that if interest rates are going up, then the value of your portfolio is going to go down. So they're not necessarily asking for a numerical description of the sensitivity, but just some words. An example would be if there was a significant increase in interest rates, then we would see a significant increase or decrease in the value of our portfolio. So that's sort of a narrative way to enhance your disclosure around fair value instruments. And then level 3 assets, you probably get into a bit more granularity where you walk through the pricing model. If you have a number of instruments that are subject to different valuation techniques, you're probably going to want to put a table in your footnotes that stratifies those investments into different categories and then says, here's the valuation model that we applied against those categories. And then again, to the extent that there are significant assumptions that might change or that have changed year on year, you're going to want to talk about those changes and disclose them. And again, getting back to what is the SEC's ultimate goal here? It's to increase the transparency and inform the readers of the financial statements so that even if it's appropriate, maybe the fair value of one of your instruments declines significantly year on year because of, let's say, a change in interest rates. They want to make sure that the change in interest rates is both explained in the footnote and then the impact of that is illustrated to the reader of the financial statements. So, when you're going through, and I've found certainly in preparing and reviewing financial statements, the fair value disclosures, especially when a company has a number of instruments that are subject to this is now the largest portion of the footnotes and the largest single disclosure item. So you want to make sure that you're spending a fair amount of time looking at your GAAP checklist as you're going through the disclosures and making sure you've done it to some degree of granularity, because if you just do it at the financial statement level, the SEC is going to come back and ask you for a deeper dive. So make sure that if you've got financial instruments, you're breaking them into their logical categories, whether it be by instrument type, whether it be by maturity or risk profile, so that at least there's some segmentation of your instruments, and then you've got the assumptions diving into those instruments spelled out in the financial statements.
Matt, a quick question for you. Have you and your client base seen anything about questions related to, did you consider multiple valuation techniques?
Yeah, especially with respect to instruments that get more complex, derivatives and hedging instruments. And they want to make sure that if you're getting, oftentimes you're getting a quote directly from the entity that's doing the trades for you, or the broker or the custodian, and they want to make sure that the company is at least internally running models that validate the assumptions that are contained in the bank models. So it's certainly they want to know that you as the registrant understand what those third parties are doing and how they're calculating that, so that you're not just relying on the black box of an external provider.
Good, thank you. The next one is one that actually we recently helped a client with an issue similar to this. And a new focus area, basically debt, is obviously a big area for companies to worry about, and the SEC to look at. And this particular comment relates to the refinancing. And they're challenging, or they're questioning whether or not there was any gain or loss on the exchange and whether that was evaluated properly. And they've even quoted topic 470-50, 49, and 10 as the guidance. So this one obviously required a response. So basically what they're saying here is that, and this particular case is something other than a troubled debt restructuring, so that's a different issue. We won't talk about that. But basically what they're saying is that when there's an exchange of debt instruments with potentially there could be substantially different terms, thus resulting in a modification and a debt extinguishment that should be accounted for in accordance with actually ASC 405. So the bottom line is, what you have to look for and have to analyze is the original debt instrument that's exchanged for the new one has to be, that you have to do a cash flow analysis on the future cash flows, the remaining cash flows on the existing debt, what they would have been, and the cash flows on the new debt to determine whether or not they are within less than 10% different. If they're less than 10%, different, you're okay. You don't have to go through the extinguishment accounting and record a gain or loss. But if it's more than 10%, you have to actually record a gain or loss on it, because that's considered a significant modification and it follows extinguishment accounting. But as you might expect, there are some nuances to that whole thing. If there's less than a 10% difference, they may not be considered substantially different unless the modification affects an existing embedded conversion option. And we all know, especially in the Valley, a lot of debt has conversion options embedded into it. So you have to look at that and what that fair value is. Because if the fair value of the embedded conversion option was more than 10% of the carrying value of the original debt before the modification, then it kicks you into the significant modification classification, and you have to look at extinguishment accounting for that. The other nuance is that if the exchange of the debt instrument either adds a substantive conversion option or eliminates a substantive conversion option that existed previously, it also kicks you into that. So you've got some nuances that you have to consider. So you can't just look at debt and say, I borrowed money and I paid and we exchanged it. You have to look at the terms, any embedded features of the two different notes, and evaluate it. And then, of course, don't forget about disclosures. What the SEC is looking for is a discussion around what were the significant components of the exchange, of the debt, how was the analysis developed, and what the conclusions were that you came to based on that analysis. So it's just like the fair value information that Matt was talking about. They want to understand the assumptions you used, how you calculated things, and what those conclusions were that gave rise to your conclusion that it's either extinguishment accounting or not, and thus the gain or loss that may be needed to be recorded. So there's some nuances there. It's an interesting one. It's probably one that people don't immediately pop to mind that there could be significant issues and accounting around it.
Now, what's interesting is the SEC has historically tried to drive companies to more of a plain English approach without citing all of the ASC codes, and yet in these comments, when they asked in this comment the debt refinance, we actually cut out the second half of the comment letter just because it got too long here, but the second half of the comment specifically asked the company to revise the notes and discuss the accounting treatment based on the appropriate accounting literature. So they're really asking for specific citation of the rules that you're looking at and how you interpret those rules. So it certainly seems to be getting away from the concept of plain English when they're asking to respond to these comments.
Yeah, thanks, Matt. That's a good point. I think this one's yours.
All right. So this comment focuses on revenue recognition, multiple element arrangements, and as you're aware, under the new revenue standards several years ago, the requirement to evaluate a hardware transaction with software no longer falls under software rules. You are allowed to split that transaction into its components, and anything that does not have a material component of software to it is allowed to be treated as hardware. And so as a result, the rules really mandate that you can no longer defer revenue just because there's some undelivered component of software or software support services. And so the way the accounting literature treats this is it drives you to evaluate the estimated selling price for each of the items on a standalone basis. And the hierarchy of methods that you're supposed to use to determine selling price is either vendor-specific objective evidence, which is what that company would does or currently sell that item for on a standalone basis. Third-party estimate, where you're taking a look at your competitors in the marketplace and saying what do they sell the instrument for or the item for. And then finally, the item we have up here, which is BESP, and that's basically if you don't sell the item on a standalone basis and you can't really decipher what your competitors charge, then you're allowed to just default to your best estimate of selling price. And for the majority of multiple element arrangements, if you read through the disclosures, everybody is using best estimate of selling price except for those companies that were historically software. And so certainly there is again, it gets into what level of granularity is the company going through to identify their selling price for each of the items. And if you've got a company that's got a large volume of transactions, they may not necessarily be carving out the proper value for the items on a standalone basis. So, the SEC here is on the focus of timing and recognition of software sales. And, what's interesting about this comment is it really implies a degree of precision in determining the estimated selling price that I think doesn't exist. If you look at a lot of the boilerplate disclosures companies pull up in terms of how do they estimate selling price, it's just sort of an amalgamation of words that really, when you go back, in my experience has been companies, and you go back and you're trying to audit this and you say, well, what does that really mean? And you find out that the person who's developing the disclosure is independent of the person who's actually doing the selling price analysis. So again, you're going to want to make sure that when you're developing your revenue recognition footnote, you really do have some intelligence behind understanding how you're carving out prices for items that are bundled together. And this is just a follow-on to that same comment, which is, tell us how you determined the items have separate standalone value, and how you isolated separate units of accounting. You can go ahead, Michelle, next slide. And again, just walking through some of the more specific disclosures under ASC is the nature of the elements involved. And as you can imagine, with a company that has a significant variety of products and services, the disclosures that are mandated here under the new accounting rules are pretty significant. If you're going to talk about the period over which each unit of accounting is recognized, that can vary substantially depending on what it is you're selling. And then, the method for determining whether things qualify as a separate unit of accounting and whether or not they have standalone value. Again, if you're talking about a significant number of items and you want to walk through the criteria for how you determine you had standalone value, that could get very wordy. And so I think almost automatically companies that have complex product and services arrangements sort of default back to a more generic description of these items and determination of standalone value. And so that's what the SEC is really asking, is for companies that have done this at sort of a summary level to dive in and develop a table, if you will, or just more narrative around how you determine separate units of accounting and then how you allocate value among those units.
Yeah, I might add, Matt, that for companies that are moving quickly, growing quickly, adding new products and services, changing their mix of products and services on a very regular basis, the finance department has to keep a close eye on, or keep their finger on the pulse of the sales and marketing organization to understand that. Because from quarter to quarter, your disclosure may have to change, your analysis may have to change or be expanded or contracted depending on what's coming into, being introduced, not being introduced, being taken off the market, etc. So be very cognizant of that even between quarters, you may have to change your disclosures. And it may be significant depending on whether or not an entire product line is mothballed or things like that. Don't know if you've seen that, Matt, but we've seen it with a couple of our consulting clients.
Yeah, and again, this is an area where you can expect, if there's any degree of judgment or complexity, that the SEC is likely going to ask for the analyses behind the disclosures and say to the company, how are you segmenting revenue? How are you looking at it from an internal perspective? And really their intent there is that however management analyzes revenue transactions for their own purposes internally, they would like you to be able to share some of that same analysis with the external world so that the investors can understand how it is you're looking at your own business.
Okay, we're going to go into polling question number 4, and remember, for CE you need to answer 75% of these questions. And question number 4 is, under the existing revenue standards, fewer tech companies are subject to the software rules. Is that true or false, or are you not sure? We want to give you a little more time to answer that polling question. So we'll give you another 3 seconds. And we've got 3 and 2 and 1, and we'll close the poll.
So it looks like the audience thought, I guess it was split vote on this one, and the correct answer is true, that fewer tech companies are subject to software rules. Under the new rules, well, I guess they're about 3 years old now, those rules, relatively new, mandate that you carve out values for any hardware when the software is not essential to the functionality of that hardware. So it certainly made the accounting a lot easier and led to quite a bit less deferrals, which was the intent of the FASB. They were just saying, hey, the economic reality of this thing is that software is not a huge component of the delivered item, and therefore you should be able to separate values. So that was the answer.
Next, we're going to take a look at some and discuss a few risk factor and non-GAAP financial measure comments. And this particular comment relates to disclosures to address specific material risks to the company. So that's the key here, specific. What the SEC is seeing a lot of and responding to is generic risk factors that are being put into filings. And what they're looking for is they want risk factors that are pertinent to and can be understood through the eyes of the management team. Why is this risk specifically a risk for us as a company? So in your risk factors, you've got to think about things like and discuss things, key drivers to the business. What are the risks to those? The challenges that you face in the market with the general economy. What are material trends affecting your operations and the risk to your operations if you're going through expansion? What are the risks specific to your expansion strategy? If it's Europe you're expanding to, if it's Asia, if it's South America, the risks in those different countries can be significantly different. So they don't want to see a generic risk of moving into a country that is is a little new to you. They want to understand what are those risks that you're worried about and that you have to deal with. So again, the most important thing is be specific to your company, not generic to your industry. And if appropriate, give warnings, early warnings of those risks and how they're impacting you as a company. Just because you have a risk if you do have a risk in a specific area and you think you are having your risk mitigation strategies are not necessarily working, you should be saying something about that and that you're adjusting your strategy potentially. So keep that in mind. This is not a finance only or legal only piece of the disclosures. This is a business people as well. You've got to get the CEO, the head of sales, head of operations, manufacturing, whoever it may be. You've got to get them involved in this. They need to understand that this is important, that we get it right.
And now we'll talk a little bit about non-GAAP financial measures. Back in 2002, the SEC passed the rule which was referred to as Regulation G, and that really speaks to any non-GAAP financial measures, and those would be anything that excluding other operating statistics. So the Regulation G doesn't apply to disclosure around unit sales, number of employees, number of subscribers, customers, items like that. It's really intended to focus on or create a rule around any non-GAAP financial measures that you're disclosing either in your filings or in another manner. And some common measures would be EBITDA or adjusted EBITDA, funds from operations, and then other similar items. So the rule specific to that is Rule 100, and that effectively says wherever there is a non-GAAP financial measure disclosed, you have to do a presentation of the most directly comparable measure, and you have to do a reconciliation between the two. So this one, the non-GAAP financial measure that the SEC commented on was, I'm sorry, Michelle, go back one quick slide. The first one, they were just speaking to the fact that there was a lack of a reconciliation between, or no, sorry. Go ahead. Is this the first slide? So the first one, we're just talking about EBITDA and some items that were excluded, and this is often a common thing a company will do, is they'll just pull items out that were expenses for the quarter, or in this case, income for the quarter. And the SEC is basically saying, take a look at the rule. It requires that anything that could recur likely in the next 2 years, either forward or back, is not an exceptional item, and you should not be pulling this out of your EBITDA disclosure. So let's jump to the next slide. The next slide is speaking to the statement of earnings, and oftentimes what companies will do in their, not in their financial statements, but in their press release, would be to take a statement of earnings and then roll it forward left to right so that you've got a new statement of earnings that is not GAAP, and basically they're adjusting out again items they feel are non-recurring one-time items. And the SEC rule on this is pretty specific. They only want you to do a reconciliation of the non-GAAP measures. They don't want to see a full-blown P&L that is a non-GAAP P&L. And then this item, or this comment that the SEC is giving, is taking a listen to the transcript of the conference call with the CEO. They're saying you, the CEO, spoke to non-GAAP financial measures, and then they're saying, tell us how you met Regulation G. And the requirement there, even if a company has done an oral presentation to investors or done a webcast or a broadcast, the requirement is that at the completion of that, the person doing the presentation would tell the investors that you need to take a look at our website, and on our website is going to be a reconciliation of the GAAP measure, the non-GAAP measure that I discussed with the GAAP measure. So again, the SEC's intent here is to make sure that you're not overemphasizing non-GAAP measures. You can keep rolling, Michelle. Yeah, these are the rules I just talked about.
Okay, so now we're on to polling question number 5. This is our last polling question, and it's a true or false. The SEC typically only examines documents filed with them. Is that true or false? You'll be sure to want to answer this question, so you're fulfilling the requirement. This is our last question. Is it true or false, or are you not sure? So we're going to leave the poll up for another 3 seconds. So we've got 3 and 2 and 1, and we'll close the poll.
Okay, it looks like the majority of the respondents got it right. It's false. As Matt pointed out in that last SEC comment, they listened to the earnings call, probably a replay of it, may have been live, and when the CFO in that he was using his non-GAAP measures, they're challenging whether or not that's misleading and whether it meets the rules. They will read significant amount of outside material that the company may produce. They'll look at your website. They'll listen to calls with investors. They will listen to either recorded speeches or articles in newspapers or magazines that people in your organization have been quoted. So you need to make sure that everyone understands they need to be singing from the same hymnal. And understand the implications of saying something just off the cuff might be very difficult to explain to the SEC. So our role in the finance organizations is to counsel our operations, management, and salespeople to say the right things. So keep that in mind. That's very important. All right, let's jump in to a couple of comments on Solar City's S1 that was filed. The first one here relates to revenue, obviously. We've talked about that already, and they have a response that you can read here. But basically, the issue was around multi-element revenue, and they were challenging whether or not they were breaking things out and explaining those things properly in their disclosure. They even cite the specific page they are having a concern with in their filing. So to emphasize what Matt discussed earlier about multi-element revenue arrangements, this example, the SEC is saying further clarification around the various revenue components is required. Thoroughly review, or our guidance here is that you thoroughly review ASC 605, review filings from similar companies in your industry to see what they have said, see if there's been SEC comment letters related to what they said before you pattern anything after what they've done. And just make sure that you understand what your disclosures should be and whether they can stand up to the scrutiny of the SEC. So, you know, my advice is reread your documents before you get them filed and beat them up. Okay. Matt's going to take one now.
So this was another comment that Solar City got in the course of their S1 IPO filing, and this is cheap stock lookback. And effectively what the SEC does here is takes a look at any stock or options that were issued in the 18 months preceding the IPO date, and then they compare that against the actual IPO price, and there's a presumption that anything that was granted at below the IPO price is automatically subject to a cheap stock charge unless you can defend against it. So certainly one of the best defenses against this is as you approach the IPO window, you want to be getting quarterly valuations of your common stock. And I mean, what's interesting about this is even in this comment, you look at the very last sentence here and it says the SEC is not going to be able to complete our evaluation until the IPO range has been disclosed. So, I mean, what I find very interesting about this is the SEC is already presuming that the stock is cheap, even though the company and the underwriters have not yet determined the price of the stock. So, again, it just highlights their sensitivity around this issue and the importance of making sure that you've got all your 409As done so that you have a very defendable position against the SEC, and also becomes a tax issue that if you granted shares or options below the fair value, then that could be taxable income to the employee at the time of grant, even if they didn't exercise. So again, just want to make sure that you have all your valuations done and you're considering what the SEC may comment upon.
Okay, we're going to jump to a couple of pointers on best practices to responding to comment letters. So basically here, what you got to consider is has the SEC challenged the accounting, or is it a disclosure-related item? So that helps you determine whether it's an impact on your financial statements or your disclosures. So evaluate and kind of bucket the comments. Make sure you consult with your SEC counsel. Never respond without getting that help. Also consult with your external auditors to get their guidance. They're going to probably have seen more comments and dealt with more comments than you have, so they're a good source of information. And then the next two, review and respond and ask for clarification. That's before you actually respond. If you've got questions about what they're intending in their comment, call the SEC staff reviewer. Their information is provided to you, and ask for clarification, which they will do their best to clarify so that you can better answer and respond to them. And make sure you file your response timely.
Yeah, and we found that the SEC has been pretty flexible. If the company is going through either a quarter-end close or a year-end close, or maybe there's just a transaction that they're looking at, oftentimes if you just send a letter back to the SEC, because they're going to prescribe a response date, but often if you just reply back to them and say, hey, the company's going through X, Y, and Z, can we get a 1 week or 2 week reprieve? Usually the SEC is fine. I've never seen them not reply, okay, you can have another 1 or 2 weeks. So just keep that in mind.
Good point.
So what to include? I think, again, the best method here is include the least amount of information that you can in responding to their question, because likely if you give them more information than they're asking for, that's going to lead to further questions and further analysis, further supplemental information, and just increase the likelihood they might find something that is just going to cause you to expend more time and energy than is necessary. If it's immaterial, make sure you tell them that right out front. Give them the dollar amount so they can be assured that it's immaterial, and then they can move on to the next item. The status of the comments, oftentimes you will reply to an initial comment letter and waiting for their response to your response. And if you don't get one, put a phone call in. Don't be afraid. The SEC are just people on the other side, and they're usually very agreeable to telling you what's going on their side and their timeline. And then certainly if you have any, if the SEC comes back with a second round of comments, you want to make sure you just don't ignore those. And then at the end of the day, they should be issuing you a completion letter, which effectively says all matters that we've advised you of are closed, assuming that you're going to be dealing with the forward-looking items as you have mentioned in your response letter.
All right. Well, we're coming to the conclusion here, but we do have time for just a few questions that have come in. Be sure to type in any others that you would like to ask. But today during this webinar, we covered our SEC comments, key issues of focus, the process, and some best practices, and really want to thank Matt and Dave for all their insight and advice around these issues. So here is one of our first questions is, how frequently can I expect to be reviewed by the SEC?
The answer is, depending on the size of the company, it's either going to be every 3 years or every 2 years.
All right, very good. And let's see, we have a minute more. How about how many rounds of questions can I expect to go through?
You're generally going to see a minimum of 2. And average seems to be settling in around 3.
Okay.
Yeah, and the good news there is, though, at least each of the successive letters you get are going to be smaller than the initial one, so you're sort of whittling down the answers until you get to 0.
Yeah, good point.
Okay, so I want to remind you at the end of this survey, at the end of this webinar, there will be a survey that you'll want to complete. And on that survey, we're actually offering a free 1-hour review of your next filing, and Matt and Dave can certainly help you with that. So be sure to go ahead and complete the survey. And up here on the slide deck now are the contact information for Matt and Dave. They're also, of course, on the website. And we really want to thank you for taking your busy time to join us for this hour. I found it really interesting. I hope that you got good value out of it. And we will see you next time. Look for our additional webinar invitations. And thank you again for joining.